Okay, everyone. Hopefully you can all hear me. Yeah, welcome to the Twitter Spaces today. The title of the Spaces is The Future of Onchain Stablecoins. We have one more guest. Our founder, Guy, is struggling with some tech issues. He's being currently rugged at the minute. So, yeah, we're just going to kickstart the Spaces without Guy. Hopefully he joins after a few minutes. But yeah, by way of introduction, my name's Connor Ryder. I lead research at Ethena Labs. And yeah, delighted to be hosting this space today. I think I speak for everyone when I say this could be one of the most kind of stacked panels we've had on Twitter Spaces in DeFi in general. Obviously appreciate everyone coming on and joining us today. So for anyone that doesn't know, Ethena is a Delta neutral stablecoin protocol launching very soon. So with us today, we've got Rune, founder of Maker. We've got Stani, founder of Aave. We've got Sam, founder of Frax. We've got Kain, founder of Synthetix. Chris, part of the core team at Curve. And Michael, CEO of Liquity. So absolutely stacked panel, as I said before. Personally, just a word, I think it's so encouraging to see so many kind of founders from what some would consider rival protocols come together to show kind of a united front on behalf of DeFi, having an honest discussion, I guess, about what we need to improve with DeFi, and then how kind of each of us is gonna play a part in that. So yeah, no one really dialed in to hear me blab on, so I'll get moving ASAP. In terms of kind of the format for the spaces, I kind of plan on just calling people out for questions, rather than just ask, because it's such a big panel with about 8 speakers. I don't want to kind of ask a question and then people are talking over each other and no one knows when to talk. So I'll kind of single people out for questions, but at the same time, I definitely want to facilitate kind of an open discussion amongst everyone. So going to be leaving space at the end of each answer for anyone to kind of hop in with points. It's kind of like, the less talking I do, the better. And hopefully we can have some kind of great discussions here. With so many kind of big voices involved. So without further ado, I guess, I think I've kind of done the introductions for everyone, so we can kind of kick straight into it. I think a good place to start would be going to each of you guys and asking, I guess, what's top of mind with each of your projects over the next 3 to 6 months. If you can give us kind of a quick TLDR, 1 or 2 minute overview of kind of any kind of exciting updates you guys have with the protocol. So we can start with Rune. Rune, welcome to the space if you're there. Rune from Maker. So Rune and Maker kind of made some headlines lately, obviously for suggesting Solana's code base for the Maker's new chain, but also got some really kind of exciting updates with DAOs and everything going on with the endgame plan. So Rune, welcome. If you wouldn't mind giving us a quick update on any kind of Maker developments, if you can.
Sure. Thanks for setting up the space. So Maker is currently just a DAO that runs a large stablecoin, but what we're aiming to do with Endgame is to sort of take this to the next level. So what Endgame essentially is this like sort of reinvention of the Maker protocol based on everything we've learned over the last more than 8 years. We've been active and we've been growing, and all of the success and failure we've had. And really, at the core of it, our goal is to just really focus on the basic advantage that we now know that crypto has, right? Stablecoins, that's a product that makes sense. And we want to just bring it to more people. And we think there's really like 2 things that crypto has really shown to be able to do, right? So one is that people like to get yield from DeFi, right? So we had DeFi summer, we had yield farming. This kind of stuff is actually interesting and attractive, right? And it's something that draws people into crypto if you can give them yield in interesting ways. And the other thing is this merging of technology and finance and community and culture. We've seen that with NFTs, and just also the very interesting communities that we see in crypto, right, and in DeFi, with all the projects represented here as well. So what we're trying to do in Maker is to really harness this and take us to the next level. So we're launching the sub-DAOs, they're called, which are basically independent, flexible, sort of small-scale DAOs that can leverage all of the advantages, all of the experience of Maker that Maker has built up over the last 8 years to become the biggest decentralized stablecoin. And then it can really be sort of specialized in all sorts of different directions, handling different business areas. Some can focus on real assets, some can focus on Web3 and NFTs and culture and community, some can focus on cutting edge DeFi innovation. And then all of these sub-DAOs have their own tokens. So when you use our stablecoin product, like the thing that's going to make it really stand out is that there's going to be all this native yield in so many different flavors, right? So we're trying to basically, gamify it a bit more, right? It's kind of like DeFi Summer, bringing back DeFi Summer, but in a way where it never ends because it's not unsustainable, and also in a way where it doesn't blow up because it's not based on Ponzi schemes, but rather it's based on actually the solid business case and sort of the solid foundations of Maker.
Awesome. That was great updates. A lot going on in Maker, and I have a ton of questions, but we'll get to that, I guess, later in the spaces. So thanks for that update, Rune. We can hop to, I guess, Sam now from Frax. Sam, welcome. I know you guys have some exciting updates with Frax v3. I believe you kind of passed an audit recently. When launch?
Yes, sir. Hey, everyone. I'm Sam. So basically, founder Frax actually issues 3 different what we call stablecoins. So Frax, the dollar peg stablecoin. We have Frax Ether, which people know as an LSD or an LST these days. We like to call it an ETH pegged stablecoin, and the reason we do that is just the way that we see the world. Few people have called me a stablecoin maximalist, so I've just kind of ran with it and just said I'm the world's first stablecoin maximalist. We have a third stablecoin called the FPI, the Frax Price Index, which is a flat coin, so to speak. And so the way we look at the world at Frax is in stablecoin terms. So when we build things such as Frax Lend, Frax Swap, these kinds of things. Frax Lend is an isolated lending market. It's kind of similar to Aave. It's a little bit more simplified. Actually, it's just pairwise lending. When we build these things, we see it as stability mechanisms for our stablecoin. We actually look at crypto as mechanisms for stable coins. So like this is where people come up with, they say like, oh, stablecoin maximalist, and then I like to own that kind of term. And what we're working on right now, and as you said, is a total rehaul of Frax, the dollar pegged stablecoin, for Frax v3. And as you said, and you follow us pretty closely, it's finished audit, so there might or might not be some stealth mainnet deployments of Frax v3 contracts later today, specifically literally today for the astute observers. So that's the biggest update to Frax since its launch in late 2020. And we have a lot of really amazing stuff coming for the end of this year, which culminates in Frax Chain, which is a very, very different thing than your standard L2 rollup. I'd venture to say it's kind of our capstone of, Rune had a really good description of endgame of what Maker's trying to do. I think Frax Chain kind of culminates our worldview of stablecoin maximalism. Everything is kind of a stablecoin in DeFi, and the different dApps that people make are actually stablecoin stability mechanisms. That's what it really is, whether they know it or not. And so with that worldview, we've designed this totally new kind of roll up system with just tons of different changes than the standard chain. Like, so obviously the one that people already probably know is like Frax Ether, the LSD is gas, but that's not the biggest change. There's like a long list of totally unique tokenomics, the way that block space is calculated and incentivized both on demand side and user side for both spending and deploying smart contracts. And it's the way that we've designed everything is totally from the ground up. And Frax Chain should be released either by the end of the year or early 2024. So we're very excited from that because it's a culmination of all of our views on how stablecoins work, and it will use all of Frax's issued stablecoins, and it'll be like a chain no one's really ever seen in terms of incentivization, in terms of functioning, and in terms of security and how we see like the roll up space progressing. So yeah, thanks.
Super, thanks, Sam. Yeah, I think it's pretty safe to say Frax is one of the protocols with probably the most going on. So, yeah, expected a kind of a lengthy update there, but I didn't expect the answer to when launched for V3 to be today. So that's super exciting stuff there, and again, can't wait to kind of dig into the details there. So yeah, I guess we can go to Stani from Aave next. Stani, again, great to have you here. Thanks so much for joining. Aave obviously kind of hitting a new era now with their Go stablecoins. So that's one of the newest stablecoins out there. So I guess, Stani, kind of, if you wouldn't mind giving an overview, kind of what's top of mind now for the next 3 to 6 months, or any kind of new updates with Aave would be great.
Yeah, so obviously Aave, we're the team that has been building the Aave V1, V2, V3 of the protocol iterations into the Aave DAO. And Aave DAO is basically a community of people who are very enthusiastic about finance, and also contributors that are directly by their service provider agreements contributing to building different kinds of tools and improvements into the protocol itself. And obviously our latest work has been the Aave protocol V3. And our mission there was to basically create a scalable lending protocol that has very good tools for risk management and asset onboarding and offboarding. So there's different things that are very innovative, such as the isolation mode, so you can list assets that are separated from the main pool, in E mode that allows higher loan to value ratios, so you get more out of your buck when you are unlocking liquidity against collaterals that have similar deviation on the market value. And in more recently, we launched the Go stablecoin. So Go is effectively a stablecoin that is minted through these facilitators, and first facilitator is to mint Go directly to the Aave protocol, meaning that you could earn with your collateral while borrowing Go and making your net borrowing rates a bit more cheaper. And Go is quite small at the moment, so it's roughly below 25 million. So I call it little Go at this point. And effectively, it opens up the doors to basically innovate and reinforce the same vision we all kind of have, that we are trying to get stablecoins and DeFi into wider adoption. And the way we see it, Aave, is that we envision a people-powered internet. If you think about, most of the internet is owned by tech giants, financial institutions. We're still using PayPal, banking systems, and very legacy software for settling transactions. And also, we create a lot of value as users, but we aren't capturing much of the value. And we believe that the progression to Web3 is progressive, that slowly we see more the DeFi world and Web3 world coming together with real world use cases. And RWAs is a good example from that. And also, we try to build beyond DeFi. So we also have built Lens Protocol, which is more of a decentralized social media. So we believe that finance will exist also beyond the actual financial protocols, but also will empower different kinds of future use cases that will be off-chain or somehow connected to the real world.
Great, thanks, Stani. I think I speak for everyone when I say kind of the more DeFi stablecoins, the better. And hopefully Go kind of grows along with the rest of DeFi. So Yeah, I think next then we can go to Kain. Kain, again, great to have you. Great to have you here, and thanks so much for joining. Yeah, I guess same question to you. Kind of what's new on your mind for the next 3 to 6 months with Synthetix? I know you guys have a Synthetix V3, and there's probably some Infinex updates there as well. But yeah, Kain, great to have you. Great to have you here, and yeah, if you wouldn't mind giving a quick intro on what's new for you.
Thanks, Connor. So I'll start with the Synthetix stuff, I think. Probably the most pertinent. So we have V3, which is now deployed. We've got a testnet competition running at the moment. And we're testing out both the V3 system and our new version of Perps V3. And so the current plan is run this testnet competition on base testnet, and then I think we will get a new version of mainnet running on base, hopefully, assuming there's no issues, in the next 2 to 3 weeks. And then at that point, we will be testing out something that at least I hope we will be testing out something that I wrote about in my most recent blog post, which is basically using some alternative collateral on base as a test case for how much demand there is for people to LP things like ETH, maybe even USDC, DAI, etc., different stablecoins on base, and whether or not people are willing to LP and trade on that system, and then out of that experiment, we will get some information, and depending on the demand for that, we'll make some decisions about where we go next. But it's pretty exciting because this will be the first time that we're like genuinely running on multiple networks with the full suite of products, right, with perps and those sorts of things, as opposed to just allowing stakers on mainnet and Optimism, which has kind of been the state for the last couple of years. So it's a big change. So that's really exciting, and there's a whole bunch of stuff that we're kind of trying to pull together, governance things over the next 3 months. So I'm working on a new blog post that will cover everything up to the end of the year, basically. That's planned, trying to kind of roll it all together into a single narrative. So that's on the Synthetix side. On the Infinex side, things are progressing really well. I tweeted about this the other day, but it's been incredible to me to see the number of different projects that exist that solve really critical infrastructure problems. As we've been building out Infinex, we hit some kind of a dead end or whatever, a roadblock, and we've reached out to the community and sort of said, hey, we need this solution, or we've got this particular problem. Does anyone know anyone who's working on that? Like really random stuff, like key management systems, right? There's like decentralized key management systems now. There's decentralized hosting solutions and infra, and front ends and back ends, and it's pretty incredible. So that's been really validating. It's helped us to accelerate the development side of things for Infinex. So the goal has always been to be ready for when Perps V3 goes live on Optimism, and that's getting pretty close. And I think right now we're tracking fairly closely. And the next thing that's launching is assuming we've got a governance vote that's out right now, that's basically deciding whether or not we want to launch SNX governance of Infinex. And if that happens, if SNX token holders vote to do that and establish a council, the next step will be governance farming. So you'll be able to connect your API keys from a bunch of centralized exchanges and farm governance, as well as farm governance with some different DeFi perp tokens. So that's going to be the next phase, is getting governance up and running and handing over control to the community. And then, hopefully, the launch is not too far away.
Awesome. Thanks, Kain. Definitely plan on digging into governance later on, hopefully in the spaces. It's definitely a hot topic. We've got a few probably interesting takes on it here. So thanks for that update. We also have Michael from Liquity, on the spaces here. So Michael, welcome to the spaces. It'd be great to kind of get any updates from yourself. Again, same question, 3 to 6 months. What's the kind of roadmap look like for Liquity V2? I know you guys are exploring now a kind of reserve back design, which definitely looks interesting. So great to have you here.
Thanks for having me. So hi, everybody. This is Michael from the Liquity team. We developed the Liquity protocol, which pioneered interest-free loans. So user can take out a loan in LUSD against their ETH. LUSD is the largest truly decentralized stablecoin and one of the few stables that have been growing in the bear market lately. And what is the team up next? So, as you said, we are working on V2, a reserve-backed stablecoin similar to Ethena Labs. And with V2, we want to overcome the limitations of our version V1. So for us, it's really creating a truly decentralized stablecoin similar to LUSD that is not reliant on the demand of borrowing. Because right now, LUSD can only be created if people borrow. And further, the second big point is takes advantage of staked ETH as a collateral. So, and therefore, we shift from a CDP-based model, which most stablecoin are based on, with individual positions, to a reserve-backed model, which has some interesting opportunities, but also quite some challenges, but it's really underexplored. And what we are working on there is we aim to have mainly two products. So first of all, again, a crypto-native stablecoin that is backed only by staked ETH and gives you access to native staking yield, which I think is very interesting. And the other product will allow you to take on leverage without ongoing fees. So to sum it up, we want to build with V2 assets for ETH believers that are almost as hard as ETH. And in V2, what we do, we actually split up staked ETH into two parts. One, a less volatile, the stablecoin, and the other part, the more volatile than the leverage product. So really working hard on that. As I said, that's a lot of research going into that. And we plan in the next, I would say, 9 months to go then live with that.
Super. Thanks, Michael. Yeah, we'll dig into the crypto native yields. Obviously, we're kind of big fans of that at Ethena here. So yeah, plenty to get into there. But yeah, great update as well. And then yeah, just two more left. We've got Chris from the core team at Curve, I believe. Chris, welcome to the spaces. Yeah, I guess similar to kind of Aave, you're also kind of entering a new era on the stablecoin front with Curve USD. So super interested to hear anything that's new there. And yeah, what's kind of top of mind for the next 3 to 6 months?
All right. Thank you, Connor. Yeah, I mean, for the next 3 or 6 months, the two main things that we're focusing on is adoption and optimization. So on the adoption side, we are, adding CRV USD onto multiple chains. So we want to, expand out from Ethereum. On the other hand, we're also creating more pools. So, for example, recently the LUSD pool with Liquity, and then also the Pi USD pool with PayPal. So I think that's one of the more important adoption that we're trying to create, kind of this stablecoin agnostic to with as many pool as possible. At the same time is to, add LPS collateral so that user can farm CRV at the same time borrowing CRV USD. So currently they can only use single token such as wrap stake F or TBTC, WBTC, and so on, Frax F. But in future they can do something like Frax F LP pool and use that as a collateral to borrow CRV USD. Then that increase the yields and increase the adoption there. On the optimization part, we try to improve the UI so that user can better optimize their positions. So when it comes to kind of analyzing the soft liquidation, that for retail user or regular user that can have a better understanding of the limits so that kind of better seamless experience. And one last thing is we're focusing a lot on also on the Asian market as well. So end of the year, we're planning to host a Curve Summit in Taiwan. So to let more user in Asia to understand CRV-USD, to understand kind of the Curve ecosystem, and create that kind of symbiosis relationship of multiple protocol. Many of them are here as well, because we believe that DeFi relies on all of us to become even stronger, and we're really just on the tip of the iceberg right now. And yeah, and one last thing on kind of this symbiosis relationship is having, this year there's a lot of the protocol that's been announced that are building specifically on top of Curve to improve that flywheel effect. Convex been one of the most notable project that has improved liquidity on both Curve and Frax. We're going to see many more protocol like that, that will help either make it easy for the bribery market, for either the delegator or the voters, which many knows the Curve war has kind of been oversimplified and at the same time complicated. So I want to make that easy as well for other protocol that will want to bribe. At the same time for voter to have more options. And on top of that, they can probably increase more yields. There's also a protocol that are building interest rate swap on top of this flywheel. So more option for the traders as well. Yeah. So overall, really exciting. And yeah, that's about it. Thanks.
Perfect. Thanks, Chris. Yeah, I think I speak for most of us here when I say the success of Curve is definitely, we're all keeping a kind of keen eye on it, as fellow DeFi protocols. So great update there. So yeah, last and hopefully not least, I think we've got Guy, founder of Ethena, on potentially burner account, because I think he was getting robbed by his own account. So Guy, hopefully you can talk. Great to have you here.
Hey guys, yeah, apologies, I do get robbed. This is a new account as of 5 minutes ago. So yeah, I guess the high-level sort of overview of what we're doing at Ethena is we're building out the vision that Arthur Hayes had for a delta-neutral stablecoin. We do this by delta hedging staked Ethereum on both centralized and decentralized exchange venues, so that could include places like Synthetix as well. The basic product construct looks like being long staked ETH on one side, and then you short the ETH perp on the other. And so the product of that is you create a censorship-resistant synthetic stablecoin out of those two positions. But we think a really interesting byproduct of that as well is that there's two forms of yield that you generate within that product. So you obviously have a positive carry now to being long staked Ethereum on one side. And then on the other side of that hedge, you also capture a yield in the basis and the futures markets for shorting the ETH perpetual. So we think it's quite interesting to be able to tokenize and capture that yield into a stablecoin itself and deliver two core products. The first is what we think is an interesting censorship-resistant scalable stablecoin, and then the other one is the internet bond, which contains that yield component that I described.
Great, thanks, Guy. Yeah, we'll obviously kind of dig into everything Athena's doing as we go along, and yeah, but I guess so that was kind of the high level intro from everyone. So thanks everyone. Everyone's got a chance to speak now. Again, just to thank everyone again for being here. It's great to have everyone. So yeah, so I guess on the topic of kind of crypto native yield and I guess yield bearing stablecoins. One for specifically kind of Rune and Sam at Maker and Frax. With SDI and SFrax, you guys are kind of making design decisions there to kind of leverage, I guess, the yield from real world assets. If one or both of you want to take this question, feel free. But can you talk about your kind of decisions around the design there, and maybe I guess how you see kind of real world assets fitting into DeFi more broadly?
Yeah, I can give our standard response to this first, because of course you should probably imagine this is the kind of question we get all the time in Maker. And so sorry, my voice is a little troubled. Basically, the fundamental driver of real-world assets in DeFi is this thing called the stablecoin trilemma, right? Where it turns out that users, they're not really that interested in all sorts of complicated explanations, right? They want something easy and simple and convenient for them, and they want something they're familiar with and that they trust. And for a stablecoin, that means it's got to be pegged to the US dollar, and you can't really screw too much around with that. Basically, if you look at the market, then as soon as something is not properly pegged to the US dollar, very quickly it just simply can't grow at all. And then the stablecoin trilemma is this issue where you can't stay pegged to the US dollar and also scale up to a very large size, hundreds of millions or billions, without also basically using something that has effectively the value that's tied to the US dollar as collateral, which is kind of this is really, it's kind of like physics almost, right? Like the laws of gravity or something, that if you want to offer a product that's worth $1 and you want to do it at a very large scale, then the product has to be it's got to be something that essentially is tied to the US dollar, right? You can't turn apples into oranges, right? No matter how many equations or whatever you try to do, at least not at scale. You can, to some extent, do it at small scale, I believe. And so Maker was always a project that we were sort of straddling the idealism of crypto, and then also the kind of the practical and the sort of the pragmatic possibilities of what can be done with blockchain technology and how it can help regular people and improve lives and make finance more efficient. So our objective has always been to make something that actually can get large scale adoption. So very early on we realized this stablecoin trilemma, and that's essentially what caused us to very early on try to figure out how do you then get into what we now call real world assets, basically assets that have a sort of a legal mechanism to them, right? That enforce collateral that backs something on the blockchain, but that collateral ultimately has its value from legal mechanisms. And yeah, it's one of the most complicated things you can possibly deal with in crypto. The approach we're taking in Maker today, which is still very early, is one where essentially you have these structures located around the world in various jurisdictions that then each of them basically sort of control a legal claim to real world assets that are then essentially connected to the governance of the stablecoin protocol. So it becomes possible for ultimately the MKR voters, the governance mechanisms of Maker, to actually have real recourse against those assets. And as a result, Maker can deploy capital into the real world and into things like treasuries, but also take it back out again, right? So to contract, reduce the exposure, basically take capital out and use that to then buy back DAI and reduce the circulation, and this way properly maintain the peg of the Onchain stablecoin with these assets that are sitting out there in the real world. Now, okay, so one thing to mention is that the next phase for this is going to be tokenized on-chain legal assets, which are even more complicated than what I just described. Because, yeah, I don't even want to get into that right now. But it's really, really a challenge. But it's also amazing if it can be achieved at scale. I think obviously the biggest thing you immediately have to really, really think about a lot as soon as you have this kind of connection to the real world. And I think also this is more like a general thing in crypto and in DeFi, right? That it turns out as soon as you want to do something like mildly exciting or like moderately exciting, right? Immediately you're suddenly thrust back into the real world, and you've got to deal with all the sort of the trappings of real life, including politics and regulation and legal issues and even like human issues, like social even problems or sort of trust issues, corruption, all of this stuff. And that's really like, I mean, that's been our biggest problem with trying to roll out real assets in Maker, despite having, we've been working on it for like probably something like 6 years at this point. So we very early realized we had to go down this path. But it's only about a year ago that we properly sort of managed to figure out even the simplest model that was capable of working at scale. What is pretty cool about DAI and Onchain Stablecoins and how they can, how they can tap into real assets is, I think ultimately the blockchain and decentralized governance and DAOs and everything that it stands for, I think they actually do offer like better tools to deal with all these real life issues that you've got to, that everyone's dealing with, that the financial system is dealing with, that any DeFi protocol that's trying to scale sooner or later runs into. Like blockchain is just very powerful for things like managing that, ensuring that you've got total transparency into all of your exposure to your assets, right? But also things like actually guaranteeing that, the DAO, that there is this sort of legal claim from something like the DAO that works as intended, and you can really see it, you can really prove it's there. So I hope that it's possible to forever continue to scale and integrate real assets, especially because there are some jurisdictions, there's some really forward-looking countries that seem very keen on making sure that they become a hub for it, right? And I always talk about Japan and South Korea as some of really like my favorite countries for doing cutting edge stuff with crypto and DeFi, just because of the kind of the political attitude there. But yeah, I think this is really like it's if we can really crack it open, we can bring in the financial system, we can get it done at scale, we can overcome these challenges with regulation. Then this will really be like the thing that just that sort of causes DeFi and crypto to, I mean, you could say assimilate or merge or take over the financial system.
Yeah, that's really well said, Rune. And I'll try to keep my answer for Frax's side quick, but it's very very well described as Rune said. Basically, to kind of explain in high level terms how Frax sees the world is we think in very long terms. We think instead of 3 to 6 months as we started this talk, we think 3 to 6 years and the next decade or two. And our view is, what are the essential units of account that are going to be important in the next like decade or two? And for us, we think, like Rune said, exactly, dollars, ETH and Bitcoin, basically, and some kind of stable, non-volatile, non-nation state coin, which is why we have kind of the CPI experimental take and iterative approach to our third issued stablecoin. And our view is the largest issuers of these units are going to be the most important and the most powerful entities, whether the protocols, decentralized ones, or they're literally centralized ones like Tether or something. Our view is these are the most important units in the next decades for the 21st century. Basically, dollars, the two biggest digital decentralized assets, ETH and BTC, and some new experimental stable unit. This is why we issue these 3 units. It's a very coherent and a very big bet on how we understand the world. And so basically looking at the dollar peg stablecoin Frax, exactly as Rune said, our view is that we want Frax to be one of the largest issuers of dollar units. We want the Frax protocol to be an extremely important entity, and hopefully multi-trillion dollars in issued stablecoins, across these different pegs in the next decade or two. And the way that we think about it is the same as Rune. It's the stablecoin trilemma is a huge issue, and I'm really interested in how Ethena is tackling that. And our view of it is that as you grow in size, it's very difficult, if not impossible, to evade nation states or government regulation via kind of decentralization, quote, quote, for a USD stablecoin at scale. So actually, analyzing the sentence basically, right? At scale, at size, it's impossible to evade government regulation for a USD stablecoin of size. And so, but by that, we mean, if we're trying to have Frax or, the other stablecoin issuers in this panel who are all brilliant, we have to figure out how to tackle that issue, right? And so Maker has a really brilliant way of kind of decentralizing the jurisdictional risk, right? And so for Frax, we obviously have our own take with Frax v3, which answers that in our own unique way. But the high level thing here is for the USD units, for the USD stablecoin issuance liability, right? Protocols that issue a liability denominated in USD. How do you actually scale this into the hundreds of billions of dollars and hopefully trillions, in the next decade, and are able to actually interact in some way with governments, nation states, government regulations? Because our claim, and I think Rune probably would agree with me, and Maker has been the leader and trailblazer in this area, and hopefully Frax follows suit, shortly, like right after them in our own unique ways. If you issue USD liabilities, right, USD stablecoins, whether it's a decentralized protocol or not, at size, you need some way to interact with nation states, particularly the nation state that issues USD. If you have absolutely no way of interacting with them, right, you cannot throw your hand up and say decentralization. It will not work at size. So that's our view on it. And obviously, probably there's many solutions, right? And that's the way that Frax is looking at it. Yeah.
Awesome. Some interesting takes there, definitely. Yeah, be interested to kind of hear other people's opinion on the panel. Specifically, that kind of statement that you need a way to interact with nation states to scale is an interesting one. There's obviously different approaches to kind of handling that. Kain, I might spin this one to you as the head of DeFi according to your Twitter bio. How do you feel about that versus the kind of the onboarding of real world assets? Has your view on that changed at all? And how does it kind of impact DeFi, do you think?
Well, I think we should be working to shut down nation states is probably the long-term goal, but that's a different story. I was very weirdly, like I went through a weird journey on this, right? When I first started getting into smart contracts, I kind of went down the rabbit hole of like RWAs, particularly around like tokenized equity. And then I realized that actually tokens were a way better solution to that problem, and tokenized equity for early stage stuff didn't really make that much sense. And so I kind of went from an RWA maxi to like a decentralization maxi, but I've kind of come full circle now, and I think I was mid curving the RWA narrative a little bit the last few years, and I do think that there are ways to do it, and I think that as long as there is the kind of incentive, right? And I think maybe the incentives were missing previously, or a little bit of infrastructure. There are just a few components that were missing, but I think we're now at a point where the incentives are definitely there and the infrastructure is there, and we're seeing RWAs brought on chain, and some of the ideas which obviously, like car loans, I don't think were a good idea, and they may never be a good idea. Some of you might remember a particular shitcoin that tried to do that. But I think that there are things that could potentially be brought on chain that will be very interesting. But starting with the obvious stuff like treasuries, I think is the best kind of path forward. That said, for us at Synthetix, we've always tried to stay on the kind of purely decentralized front and not connect to RWAs. We don't even have entities. So, there isn't really any way for us to interact with the real world in that respect. That's why I think it's good that there are other people that are doing that work that do have entities bringing things on chain that, we can interact with.
Yeah. Sorry, Michael, you were about to speak.
Yeah, on the same lines, I think there we are aligned with Synthetix. I think users realize, that not all stablecoins are equal. And they have different risk profiles and different use cases. I think there is really a world of these more centralized stablecoins that maybe can fully scale, but have some risks and counterparty risks. But I also think in a diversified portfolio, there is the need for decentralized stablecoin or a stablecoin that has no ties, is not dependent on fiat rails, fiat collateral, or fiat yield, and takes full advantage kind of the technology we are building on. And I just think it's really an underexplored area. So I said LUSD has currently 260 millions. And I think we don't need 100 billions, but we should have at least more billions in these stable coins. Because I think that's a bit the goal of DeFi, having this autarky, kind of crypto autarky for yourself, for your treasuries, not your keys, not your stable. And I think that's something we really care about and look into. And I just think something we should care also as a space more, that we have these options. And right now I feel a lot of stables are tapping into the treasury yields, which is great. But at the end, it's the last mile. It's streaming Fed yields to the wallet, which is convenient and which I probably also would use. But I think we also need these more native ones where we can access the staking yield and which keep us autark from the other system. And I think that's, I think we just need the full spectrum, and we should look at stable coins as a portfolio of dollars, each with different risk and properties. And I mean, from the Liquity side, as Kain said, and Synthetix, we're trying to cater to the one end of the spectrum. So as a user, we have the choice and can shift.
Yeah, I think users having that choice is key. And one thing I wanted to get into and dig deeper on is this. With the sources of yield question, obviously real world assets are pretty appealing right now, kind of yielding 4 or 5%. But over the last year, 6 months, we've got a kind of crypto native yield pop up in the form of staked Ethereum and other staked assets. So Guy, I might loop you in here. It's kind of it's on the kind of topic of taking this pragmatic approach, but I guess there's ways to do this also with crypto native yields.
Yeah, sure. So I think first I just want to maybe comment on some of the comments from Rune and Sam, where I think I fully agree that if you're talking about the scale of hundreds of billions of dollars, clearly using a US Treasury is the only way that you're going to be able to support that type of flow. I think for us, it's actually just digging a bit deeper into how narrowly are you defining each piece of that trilemma, and just trying to dig a bit deeper into each of those items. So I think from my perspective, no one can really credibly claim to be a purely decentralized stablecoin outside of maybe just Liquity V1. And then on the other side of that, if we're talking about scale, I think it is really how are you defining, how do you sort of achieve like full scale? Is it hundreds of billions, or is it billions that can still cater for the demand within crypto? So I think our approach is actually just trying to sit between those extremes where you have Tether, which is infinitely scalable for the purpose of crypto, and then you've got CDP designs within DeFi, which are a bit more decentralized, but obviously have constraints around how far they can scale. I think our approach here is to say, really within the decentralization piece, the narrow definition that we're trying to solve for is actually removing collateral from the banking system, and the way that we do that is essentially replacing US Treasuries sitting within an SPV or within a bank, and moving that to crypto collateral sitting within our own ecosystem. The scalability piece that we have taken a slightly different approach to CDPs is we can put up $1 of that staked ETH collateral, and that can generate $1 of stablecoin on the other side if you're taking out a hedge at 1-to-1 on that collateral. And so for us, we think it's a bit more scalable versus some of the CDP designs that you've seen within DeFi. And I think the last comment just on how we think about the RWA versus crypto yield. At the moment, it does feel like we're sort of reaching the somewhere near the top of the rate cycle in the real world. And I think everyone's super focused about how we import some of that yield on chain. But I think sometimes you've got to look forward 18, 24 months ahead of time and think, what is the world going to look like at that period of time? And are you sort of positioning yourself for that now? I think one of the interesting characteristics of the yield that's generated within the Ethena product is you've obviously got the staked ETH yields, which have shown like a weak negative correlation to rates in the real world. But more interestingly, the basis that you capture from shorting ETH perps is a very strong negative correlation to those rates in the real world. So if you remember last cycle, rates went from just below 1 to 0, and you saw basis within the ETH markets actually sustain itself like above 20% for large periods of 2021. And so we think that we're not sort of saying it's better or worse comparing either the custodial setup that we have or the yield source that we have within Ethena. All we're saying is that it's actually uncorrelated and it's different. And I think that some people will sort of appreciate the fact that there's different correlations in either the risk profile or the yield profile in the product.
Yeah, absolutely. And I guess this real world asset push kind of probably comes from a source of, I guess, on-chain stablecoins, maybe lagging a bit behind the off-chain stablecoins in terms of maybe adoption and volumes. Obviously, we've seen kind of Tether increase in market cap in a bear market lately. So I guess the question maybe for Stani and Chris, who we haven't heard from in a while, is kind of, do you see maybe real world assets as the push that on-chain stablecoin needs to close this gap, or how do you see that gap playing out over the next few years? Are there any other catalysts that might drive the closing of that gap?
Yeah, sorry. Oh, go ahead.
No, go ahead. Sorry.
Yeah, I just this is a fascinating discussion about kind of like the RWAs as a scaling mechanism, and I do think it comes from an interesting place, because I personally think we put a lot of effort into this by trying to distinguish, like, what are like decentralized stablecoins and what are like, more centralized, what are in between. But like, I think it's more about what are these stablecoins or on-chain value, like which kind of like economy it is relying on, right? So like, you might have, like, from a systematic perspective, a very decentralized system, but at the same time, if it's pegged, for example, US dollar, you're relying on that USD economy. So, the value and the depth will fluctuate based on the real world action of particularly that currency. And I think what's more interesting to think about is that, if the blockchain is a way of registering different kinds of values and also represent economical behaviors, like as a value network, like how we actually build an economy that is, let's say, on chain, but also isn't relying upon those economies that we're trying to get
This space was downloaded via spacesdown.com. Visit to download your spaces today.
away from. So the reason we're trying to get away from, let's say, USD or some of the banking systems that we have is because they don't really serve us the way we want them to serve. There's lack of innovation, and there's different kind of demand today. So my thinking is more about, I do think that real world assets will help for scale because the on-chain economy is very small. But I would approach also from the perspective that how do we actually build more of a new economy, and that is based on chain, by increasing the gross domestic product, on-chain gross domestic product from payments, buying and selling services through on-chain, and through kind of like a more of a different kind of economy. And I think it's valuable to think about this now than later, because internet was a big opportunity to create a new way of settling transactions, and you had interesting things forming up, for example, PayPal, and the ways that you can actually settle transactions globally. without using banking systems, but then you have to on-ramp and on-ramp obviously through a traditional financial institution. So if we're thinking that we're rebuilding the web now, and kind of like we have this, what Rune mentioned, kind of like a new, cultures and communities and economies, like how we can actually build on a new foundations. And I think that's where we have to put a lot of focus on, especially now that the backend infrastructure is here. So for DeFi, so you have Maker, you have Synthetix and Frax and Aave and all these amazing things already built, like on the back end, and how we kind of like translate the experience and build that front end DeFi so we can build a new economy. And I think that's a important thing that we have to focus. That yes, we need scale for on-chain stablecoins, and that can happen through the real world assets, but also we have to basically start growing the actual on-chain economy as well.
And Chris from Curve, had you something to add there, or what do you think?
Yeah. I mean, I think on-chain stablecoin can and should coexist with centralized stablecoins. That's why on Curve we have pools, like PayPal, PyUSD, USDT, USDC, STUSD, STBT, which was launched by Mixer. There are an RWA asset as well that tracks the T-bill. Maybe few noticed, but Curve actually used centralized stablecoin instead of Price Oracle for CRVUSD. But ultimately, the most stable decentralized stablecoin before CRVUSD were the ones that got the most adoption, right? And so how do we create adoption? That's like the question, the hardest question. Is it payment? Is it integrated with some of the Web2 application, or we think it's important for us right now, at least, is to get CRVUSD everywhere. Not necessarily Web2, but more importantly on DeFi. Get it integrated into most of the protocol. Get it listed on DEX and centralized exchanges. And there's obviously other ways of getting adoption, right? When we kind of look at how UST were adopted back in the days, where they were just crazily, printing token. Like they're probably one of the fastest adopted, I don't know if it's decentralized or centralized token for Luna UST, but they were super fast adopt, either for native crypto people or non-crypto. So there might also be something to be kind of learned from that of how it got adopted, right? Because I built some of the on-chain analytic tool on Dune to track some of the stablecoin protocol, and also obviously Curve and CRVUSD. You'll see that most of the liquidity provider or depositor that are providing collaterals are less than, I think, 500. So some people use multiple addresses. So we're probably really down to just a few, maybe let's say 1,000 people that are providing collaterals. So there are really not that many users. Most people that are using are native DeFi people that understand the game, the flywheels, understand the risk. But it's not necessarily people that would like to hold these stablecoin and OTC for fiat. For example, I'm in Taiwan. There's a lot of these OTC where you can give them $100 USDT, and they will give you $100 USDT worth of Taiwan dollar. And Taiwan is a very cash focused place, so you can use that everywhere. So the on ramp and off ramp for USDT is it's everywhere in Taiwan. How do we get that? Then these kind of I guess OTC people or OTC desks to adopt to DeFi, so they will be willing to hold CRV-USD, be willing to hold DAI, LUSD, and Frax, right? Because it will probably make a lot more sense for them, because then they'll actually be earning a bit more yields than just simply holding USDT. So I think another way of looking at adoption is to see how a lot of these centralized stablecoin are being used, and how to kind of convince the people that are actually holding these USDT. A lot of them are in Asia, and how to convince them, to hold decentralized stablecoin. I think that will be one of the key for adoption for all of us. Yeah, thank you.
Yeah, thanks, Chris. Yeah, kind of, I guess from yourself and Stani's answer there, what I kind of get out of that is that we kind of need to build a kind of demand case for these on-chain stablecoins. So maybe Kain or Rune, I can pull in yourselves here, as I haven't heard from you guys in a while. But do you think we're kind of making enough steps to build that demand side? And then also, do you think DeFi infrastructure is in a good enough place right now that if that demand was to come, that we're built for that? I believe, and I believe the answer is yes. But maybe the more interesting one is kind of how do we feel about building that demand side of things? Is DeFi doing enough on that front?
You can take it, Rune.
Can you hear me?
Can hear you now, yeah.
Yeah, so how to build demand for stablecoins. That's how I understood the question.
Yep.
So the thing is that, I think a lot of founders in crypto, I realized way too late that this is, there's this joke of first time founders care about product, and then second time founders care about distribution, right? That this question of how to build demand, how to get users, right? How to get people to use your stuff. That is in fact, it's the only thing that really matters. Every single other question, every single other problem follows from this fundamental question, right? And the thing that's really funny about how to get demand for stablecoins is, I think it's so hard. We really know so little about it. So in Maker, we've over the years, we tried all sorts of stuff, and our conclusion was everything we kind of tried to do to induce demand basically didn't work ever, and had no measurable impact really. And then randomly, the DeFi summer and the bull market happened, and then there was a huge influx of users, and we didn't really know where those users were coming from. It was very hard to figure out what drives someone to make a particular decision, because the thing is the average user, our users of of the stablecoin projects, of the DeFi project and so on, mostly they're not like us, right? I mean, there's only quite few people that are crazy ultra DeFi nerds, right? That's a really, really small segment, right? And the average user, for the most part, is, I mean, we barely know who they are, other than, of course, certain whales, right? Then there are some mega early ETH whales, and then there's institutional users, and those make sense. But then they're also they're not the most interesting users, because they're very mercenary, right? They have an easy time moving around and picking wherever the yield is highest, for instance. And the real holy grail that makes stablecoins the ultimate DeFi business, and that drives this dynamic of all projects want to become stablecoins over time, which is a great thing, I think. And the reason why that's so amazing is because it's a user, a currency user that trusts that currency and uses it for saving and uses it for money. That is, a regular person, or rather a network of regular people doing that, that is just, they're incredibly valuable, those users. Yeah, so I mean, I'm saying all this just to be like, look, there will be, if we can solve this problem of how to drive the demand, I mean, it's the Midas touch, right? It's like how to turn anything into gold. Well, figure out how to generate demand for your currency, and you've pretty much cracked it. I mean, that's the closest you'll get to be able to create gold out of nothing. I mean, we're literally talking about actually creating money, right, as a business. Anyway, so yeah, unfortunately, like I said, this was the first thing I said, is we really have very little idea of what works. Like, if you look at I mean, I think the best example of like the pure money demand dynamic, I think, is if you look at something like Tether, right? It's just like, I would argue that the reason why Tether is so dominant is because it's so dominant. Like, it's pure network effects, right? So it's like Tether is like massive in like the Philippines and Turkey and Argentina and all these like countries that were for many years, right? I mean, the whole time cryptos existed, these were like considered the holy grail countries for crypto, where like it was so obvious that it was going to be this like massive sort of benefit possible, right? That we could, if we introduce this technology, introduce these products, like, we'll create tons of value, will actually help people, right? And then Tether were the first one to do it and sort of be able to do it at scale, and they just totally locked it down in many ways, right? Okay, so last thing I want to say, right, is like, what can something like Maker then do, right? So Maker is pretty big for DeFi, but actually for as sort of a stable coin and as a currency, we're actually small, and we're sort of struggling to like stay above the line of like being that sort of real money that something like Tether is, right? Like, we did, so the one thing we did find out was that like, apparently, so we increased the DAI savings rate, which is this very old product we've had in Maker for many years. Recently we implemented some regulatory measures to sort of make it possible for us to focus more on this aspect of the protocol, where basically we blocked access by Americans and VPN users, and then we started increasing the DAI savings rate beyond it, sort of, which basically in the past had been almost nothing, right? Then first we increased it to like, I think like something like 3.2%. And actually nothing really happened. Nobody used it. Then we increased it to like 8% and then down to 5%. And suddenly like DAI demand exploded. And we managed to like, really turn around this like sort of this basically the fact that DAI was like sort of just at the edge of being at that escape velocity. And I think now Maker and DAI is definitely coming back into this sort of escape velocity of being big enough that people use it because other people use it, right? At a very large scale, and which makes it very convenient to use.
Have you considered 20%?
No, that's like 5% is really, so the thing is really funny about 5%, right, is that, which actually relates to this thing of like Anchor protocol and the 20% and the sort of the ponziness of that, right? Is, I don't think necessarily it is that, like, why did 5% work when like 3.19% had no effect at all, right? So I think maybe it's not actually necessarily so much about like the yield itself. It's the fact that it's a round number, and it's the fact that it's stable. And when you start thinking about why this matters, like, I think that's the kind of mindset you have to be in to try to think about what actually causes like sort of a regular end user, like when they make that decision about, like, I mean, when someone who's choosing what stablecoin to use, even a developer that's like choosing what to build on top of, it's like it's a very emotional decision, right? It's like a very sort of, you don't sit down with like a spreadsheet or pen and paper and do some math or something, right? So it's really about like understanding, behavioral economics and very diffuse sort of human human values and characteristics, right? And so, okay, the last thing I want to say, last thing, I already said the last thing before, but absolute last thing, right, is the one idea we have in Maker of how to drive demand, how to get people into stablecoins, get them into DeFi, beyond just, you know, efficiency and higher rates and whatever, you know, sort of a race to the bottom, which is great, because I mean that's going to help the whole world by also sort of putting the financial system to the fire, right, and forcing everyone to be more efficient. But the one thing that crypto can bring to the table that I think is I mean, what I would suggest all other projects, especially like new stablecoins that are trying to sort of, you know, carve out a niche and sort of trying to get to like escape velocity or get to some kind of sustainable level, right, is that we need to try to make it basically more fun, make it more interesting, and focus more on that like sort of emotional aspect that is what causes people to make these decisions, right? And in the past, this was all attempted to be done through this question of decentralization and sort of appeal to libertarianism and all that. And I think that somewhat succeeded early on. But the reality is actually, I think that type of community is sort of limited, I think. And I think it's possible that you can go beyond and you can appeal to all sorts of different things that where people will be like, why should I have my money in some boring bank that sucks and is corporate and screws me over, when I can have my money with something that somehow, you know, resonates with who I am, or, you know, the values and the whatever, you know, the emotional things that appeals to me, right? And so in Maker, how we're trying to deliver this is with the sub-DAOs, right? That you can get your yield in many different ways with Maker. And because you can just choose to get regular old boring, you know, cash yield, or you can choose to get a yield in tokens in the form of a sub-DAO. And that is sort of an attempt to gamify savings and basically, yeah, give people this ability to say, what if savings could be more fun, right? What if it could somehow be something you want to go in and optimize your personal finances, because there's something in it more than just sitting around and you know, doing some math and kind of doing something that feels like work, essentially. So I think if any, like all the new projects all the new stablecoins, all new projects, the more they can tap into this and find ways to do this, and of course not lean into crazy Ponzi schemes or something, right? That's of course, that's the thing, is like Ponzi schemes aren't really fun, right? They sort of, you know, you need to deliver some value that isn't just you know, a bunch of money and then a huge hangover, right? But some actual community spirit, some actual, you know, like sort of intangible value that is meaningful at a human level. That's all.
Yeah, no Ponzi's, please. Yeah, no, I think obviously it is kind of the $1 trillion question, how to drive demand. But yeah, that question of, I guess, why did 3% not work and 5% did? You'd wonder, is that something to do with obviously the treasury yield and like a kind of benchmark rate that crypto has to clear? Which is something obviously interesting, and people that have that easy access to bonds can kind of just shift into, I guess, treasuries and earn those bond yields. And then that's kind of maybe why we've seen crypto liquidity drop lately, USDC market cap drop lately. So yeah, it's kind of all about driving that demand. And Guy, I know you have a couple thoughts on driving demand and kind of distribution of stablecoins in general, helping to do that.
Yeah, I think I agree with pretty much everything that Rune said. I think for us, we took the approach in thinking that we weren't as arrogant to believe that we could distribute a stablecoin on DeFi better than any of the founders who are on the panel right now. What looks slightly different about our product versus all of the pure on-chain stablecoins is we actually need to leverage centralized infrastructure to create the product. So if you're taking in staked ETH and then putting on a hedge on a centralized exchange, that's clearly a revenue stream that could be created for a centralized exchange on the other side. And then part of the yield component that I described earlier, where you've got, call it 4 to 6% on the staked ETH side, and somewhere between, and this is obviously a variable yield, but somewhere around the sort of 6 to 7% on the hedge, that obviously gives you a bit of yield to incentivize exchanges to also push your product. So I think Rune calling out USDT is exactly the right example there. I think they kind of attained what I think is basically the holy grail, which is they are actually used as money on exchanges. So the base pairs for the major sort of trading pairs of BTC and ETH, it's all sort of USDT across all major exchanges, and that just gives them an incredible network effect, which Rune called out. And so I think from our perspective, we sort of look at it and think, I don't know how many users there are on DeFi. I think the call out at 1,000 is probably fair in terms of like daily hardcore users. But then you look at the distribution channels that centralized exchanges have, and it's just several orders of magnitude higher, right? They're somewhere between 100 to 200 million users on some of these exchanges. So I think our approach is to say, instead of us going out and trying to find millions of users ourselves and bring them on chain, why don't we create a product that actually incentivizes exchanges to push it out to their users on the other side? And then you sort of narrow the band of your own customers from trying to find tens of millions of people yourself to just serving 5 exchanges who can then distribute to their users on the other side. So yeah, sort of fully agree with Rune. I think our approach here is try to not actually dismiss the centralized exchanges, but actually think about how they can be useful sort of partners to you, and then just put around the right sort of incentive structures so that they're aligned with pushing your stablecoin.
Yep, fully agree with that, obviously. And Sam, I guess from Frax, have you guys, I guess, make similar design decisions with with S-Frax? How are you guys thinking about, I guess, the benchmark yield question versus maybe treasuries, and is that what maybe crypto needs to drive that demand?
Yeah, I think it was I think it might have been Guy that brought this up that I think is a really good point, which is if you think long term, rates will probably go down. But then if you think longer term, like the way that I'm trying to think about with Frax, rates will go back up, right? So the idea here is if you have a USD issued liability, like a USD pegged stablecoin, how can you build a literally multi-trillion-dollar protocol over the next 5, 10 plus years? And the way that you need to do that is you have to be able to go the full gauntlet of in zero rates, like we've all been talking here. Everything's perfect, right? And in zero rates, we are part of the highest growth, most high tech, the best pumpamentals or whatever you want to call it, industry, right? It's the 21st century digital market of the internet of the world, right? Like in the zero rate environment where growth is extremely valuable, and like you could argue overpriced, you don't need like real world assets, T-bills, or anything like that if you're a dollar pegged stablecoin, right? It's a risk on environment. Over collateralized loans nearly scale infinitely, or these very unique, innovative stability mechanisms that everyone is talking about on this panel, right? The stuff you guys are working on at Ethena, the way that Go works, Synthetix, USD works, all of this stuff is amazing in a low to zero rate environment. You don't need to actually be able to, like I was saying originally, interact with the issuer of the unit that you're pegged to, right? You don't need to interact with the nation state of the thing you're pegged to. However, again, if your goal, which is what our goal is at Frax, is hundreds of billions of market cap, hopefully trillions in the next decade. We have a very, very, very long outlook and like a methodical way to get there. Rates will go down. They'll come back up. They might go down again, but they'll come back up, right? And so you need a structurally, as Rune likes to call astutely, end game. It's a very, very good term and a very good way to understand of being able to run the full gauntlet here, right? Which is in zero rate environment, awesome, perfect, decentralized stablecoins, decentralized lending. Everyone remembers on Aave, on Compound, people paying 10, 15% to borrow dollars, whether they're USDC, Tether, or whatever, right? During high rate environments, you issue, all of us, your protocols and stuff, we issue dollars, right? USD units. Frax issues other units too. That's why we have a, kind of overarching, stablecoin maximalist vision. But if you issue dollars, what are you going to do in these times, right? And so you have to be able to function in the entire spectrum of existence in the economy of what the actual issuer of the USD, the unit that you're being pegged to, actually does, right? Which is the US government, right? They raise rates on that unit, they lower rates on that unit. And so if there's no way you can, well, interact with that at the source, so to speak, then you kind of have a really interesting problem that's like either it's a problem that no one's been able to solve, or you just have to kind of say that, look, we peg to this unit, right? You could not peg to the unit, right? Which is why Frax says Frax Ether, right? It's pegged to ETH, right? If you the LSD is infinitely scalable, decentralized, right? Entirely awesome. If you think ETH and Bitcoin, fixed supply, new digital units are the global currency, that's amazing, right? Lido issues it, Frax issues it, Rocket Pool issues it. That's also why I really like Ethena, right? Like you guys have this very, very, perfect area of like the financial space between like straddling between ETH / like BTC hedge perps and then like dollar units. It actually could be the Goldilocks zone, so to speak. But then if you are trying to scale the dollar liability, you have to have an answer to the full pendulum, right? The full spectrum of macro rates. That's how we think about it, right? And like you can't deny that that's the full life cycle of this stuff. So yeah.
Maybe what I would be interested in, how the others think about that. Now we talked about the interest rate environment, but really looking at the future of stablecoins, in my opinion, or how I see the world, I really think there are two paths going forward. Probably either you're fully decentralized and can establish these properties and can stay as long as possible out of regulation, or probably you need to get fully regulated. And the in between, I think, will get harder and harder. So I think it's really about, that's how we think about it, to go the decentralized route and have a differentiating product there. And I think that's the important part. And that's the nice part about all the projects here. We have very differentiating approaches. And I think that's a key part for demand. So we're going more in that direction. And I think you can also go more the regulated ones. But there you need to differentiate to the big players potentially, or potentially not. Potentially overtake them. So I would be really interested to hear if the others think about it like that too, or if they have other outlooks on the stablecoin landscape.
Yeah, I guess if no one had any thoughts, conscious of time here, I know the plan is about maybe one more question each, but Rune, I know you said you have to run in a couple of minutes, so I might go to you first. Just switching gears a bit, I guess, to kind of finish off for yourselves and Maker, for the kind of end game, and then I guess on maybe the topic of sub-DAOs as well. So what's the most exciting area you think that unlocks for you guys as a protocol, maybe specifically the sub-DAOs and how that feeds into it?
Yeah, really, it's parallelization. It's the fundamental challenge of scalability, really, and trying to deliver on the original aspirational goals of DAOs as these massive structures that can somehow enable humans to coordinate at scale over the internet with minimal friction. And we couldn't make it work with the basic monolithic DAO structure. But sub-DAOs, that's really, I'm betting everything on this, right? I really believe that may be the answer. And you can think of it as, just like you have Ethereum mainnet, which is not enough to run everything. You need L2s, right, to sort of generate more bandwidth and parallelize transactions. It's sort of the same thing with what's possible with sub-DAOs, right? That they're like L2s for governance, right? And what that means is it's going to open up so many new use cases, like so many possibilities that a single monolithic DAO would never be able to do. Now, by far the most important of this is, what I was just, going on about 15 minutes ago, right? Which is driving basic product demand for stablecoins, right? So all sub-DAOs fundamentally, they have this brand, community, culture, values focus, right? They have some kind of unique way to express themselves, and they all run front ends, all they're basically all in various ways creating decentralized and centralized front ends that attract users into just using the basic stablecoin product, and then accessing yield in some way potentially. And then what's cool about this, what's cool about how the sub-DAOs can approach this is that a monolithic project that sort of tries to reach escape velocity and reach massive scale, it kind of has to attempt to appeal to like everyone, to appeal the whole world, because you just need to be so freaking big as a DAO to be able to properly maintain all the bureaucracy necessary to have checks and balances on all the different functions required to like run a financial system at scale, right? That's actually stable. But because the sub-DAOs, they share so much of this scale, they don't have they don't need to be huge. They can actually be small, and everything is great. Like, so they can all, instead of trying to like appeal to everyone and be sort of bland, right? They can be very, for the lack of a better word, edgy, right? They can have a particular shape, a particular form that targets just some specific demographic, some specific group that respond well to a certain type of marketing or a certain type of design, that makes them feel safe and comfortable and even feel fun with their savings, right? And so right now, the kind of the most extreme example that we're trying to bootstrap of this right now is the sub-DAO called Sakura DAO, which is like this Japanese themed and increasingly also now gaming focused sub-DAO that really is it's a bit of a moonshot in the sense that we're trying to say, look, we take the sub-DAO model and then we pretty much don't really overload it with too much else other than a brand and a kind of a vibe, and then we see if that enables the sub-DAO to then attract users to its front end and sort of attract a community that's interested in this kind of stuff, and basically just have it be purely about marketing, branding, building value for the community, making it sort of a fun, comfortable place to be for certain user segments, including that, of course, also it's a way to interact with the Japanese community. Japan being, as I mentioned earlier, one of these like super jurisdictions that really I think every single project should be looking into and think about how to get a presence there. There's also Spark DAO, which is one of the other sub-DAOs, and then that's a sub-DAO that is instead like focusing on this like hardcore, more like OG DeFi crowd, right? So it's possible that in the future Spark DAO might decide to like build some kind of super purity stablecoin, or some other like sort of product like that, right? And it's not realistic that a massive DAO like Maker would be able to do something like this and make these kind of decisions. But with the sub-DAOs, we make it possible because you allow a smaller group of people to basically, they hold their own tokens, they've got their own skin in the game, and they have the freedom to basically try things out. And then if it fails, it's their loss. But they also, deliberately took those risks and they didn't bring everyone else with them. And as a result, you can allow these more crazy ideas, right? These experiments and innovation, and you can really open up. And that is the key to ultimately achieving parallelization, right? A lot of different people working together in a semi-chaotic state of a lot of different things happening all at once. Some of it fails, some of it succeeds, but all of it is happening, and it's not sort of falling apart because because it gets too chaotic, right? But rather there is some order to it at the high level. So I'm super excited to see how this plays out. I really think this dynamic of everyone being able to farm the tokens, which will allow the whole ecosystem to self-organize, and everybody get to pick what sub-DAO they resonate with, that they want to participate in, right? Because you can get the tokens for free, so you can just farm the sub-DAO you like, and then basically get to work coming up with ideas, providing input on some of the experiments, if that's what they're into, or maybe if you're into TradFi, sitting and messing around with ALM parameters or something that many people wouldn't even know what it means, right? I think if something's gonna really unlock the potential of what exists in the crypto space right now, which is, I think, the latent value, the latent potential, I think, is massive, and that's really what I hope the sub-DAOs will achieve. That we will be like a way for all of this to come out there, and we'll see it in action, and we'll power it up with all of the scale and all of the experience and all of the the technology of the Maker project that has been built over the last 8 years, but which will be reinvigorated through the innovation that's possible with sub-DAOs.
Awesome, Rune. Yeah, I think I speak for everyone when I say can't wait to see how that kind of sub-DAO model plays out. Super interesting, super innovative, and that's just really just encouraging to see, I guess, new things being tried out in the bear market. So, Rune, I know you said you got to run, so thanks so much for joining us. And yeah, I guess on the topic of kind of innovative unlocks for DeFi, Kain, I might spin that one over to you. Kind of what innovations in DeFi lately are you the most excited that you've seen? And that can be your own projects or something completely different. But yeah.
Yeah, I mean, I kind of talked about this at the beginning. I think, in the bull market, there's so many things that get funded and so much noise. It's really hard to, follow everything that's going on, right? And there are so many interesting projects that are getting close to launching or, launched recently. And the noise floor has really dropped. And so, the ones that are still here, they're still building, that are building things that are not nonsense, I think are starting to get a bit of attention, which is great. And my thesis for next year is basically that the infrastructure is there, right? We've got all the things that we need in place now. Going back to the earlier question about inducing demand, there are at the moment a finite number of people that are in crypto, but of those people, the vast majority of them are using CeFi. They're trading on Binance, Bybit, OKEx, whatever. And I think that there is an opportunity for us to kind of shift that a little bit, over the next year, and start to capture some of those users who are still in crypto in the midst of a bear market, but are not in DeFi, that are not on chain, that are not doing transactions on Ethereum and L2s and things like that. And so the key question then is, okay, why are they not? Why are these users still using CeFi? And I think the reality is that they are stuck in CeFi because CeFi is much easier to use. It's much more accessible. It has user patterns that are very similar to what they use in Web 2. And that the critical thing for us to do if we're going to win over these existing crypto users that are stuck in CeFi and bring them into an on-chain world where it's harder for them to get rugged, is we need to make sure that usability is at par with CeFi. And potentially we can exceed it, but I think table stakes is getting usability up to the same standard that CeFi has. And there are a whole bunch of little things there that I think we can do. And as I said, I think most of the infrastructure to enable those things is there. From account abstraction and smart contract wallets and embedded browser keys and things that just abstract away a lot of the complexity and let people use a dApp as if it were a CeFi app, as if it were a Binance or something like that. And so that's what we're working on at Infinex, and I think it's been really gratifying to see all of the people that have built out the infrastructure to enable that. Kind of putting their hand up and saying, "Hey, I've got this component that I think would be really useful." So I think next year that's really going to be the goal, and the kind of end result, at least that I want to see, is that when new users do start coming into the ecosystem again, when the cycle shifts and we get back into a bull market, that rather than all of these new users who start falling out of the sky landing in CeFi, that they can actually land in DeFi because we give them a much easier onboarding process where their friends or relatives or whoever is advocating for crypto, and advocating for them to check out crypto again, can genuinely offer them a DeFi solution that is not going to be so hard to use that it creates risk for them that they're going to rug themselves or lose their keys or whatever. That's our goal. That's what we're trying to put in place for 2024. And I think that, as I said, we're in a really good position given all of the cool projects and infrastructure that's been built in the last 2 years.
Awesome. Yeah, I think that fits really well in with the kind of how do we drive demand question earlier, bring users to kind of DeFi. And one thing we probably didn't mention at that stage was, UX and UI needs to be up to CeFi standards. So yeah, really interesting to see what Infinex are doing on that front. I might pose the same question to Sam from Frax. How do you feel about kind of innovation in DeFi right now? Are there any new kind of innovative ideas that you think are going to help in driving that demand towards DeFi? Kind of what's exciting you right now in the space?
Yeah, so I think Rune actually said it kind of well, that when I view this through like a stablecoin maximalist lens, Rune was like, it seems like a lot of projects want to become stablecoins the longer they take and exist, right? And so everyone on this panel is extremely accomplished founders, and they have they have stablecoins, but as part of their broader protocol strategy, right? And so the way that I look at things in DeFi and just in crypto in general is that stablecoin issuance, and again, as everyone probably knows on this talk, I don't see it just as pegged to the USD. Just stablecoin issuance, meaning a liability that you want people to use as currency, basically. You want to build up monetary premium, is the ultimate DeFi monetization system, right? It's basically the ultimate product market fit of anything, right? And so I think of every kind of protocol that's being built almost like a stability mechanism for a stablecoin, whether that's an LSD, an ETH pegged stablecoin, or a dollar pegged stablecoin, or Frax has like a CPI pegged stablecoin or some more exotic type of stuff. But the main innovation that I try to look for in DeFi is there new ways in which a stable coin interacts with like a perp dex or a synthetic platform, like what Kain is saying, or like how you guys are building Ethena, and so how Curve is tackling liquidations and liquidity on chain in a decentralized manner, right? And I look at the world basically in crypto and I say, okay, where are the stable coins, right? The ETH pegged ones, the LSDs, the dollar pegged ones, any slightly exotic pegged ones, CPI ones, or whatever. What are the stability mechanisms, and how do they function, right? Right. And so, for example, with lending markets, I think of what are the most interesting lending markets that are essentially stability mechanisms for their issued stablecoins. For AMMs, I think of Curve, for example. The reason we've been so huge on Curve for a long time, and we early went all in on convex, and everyone's like, oh, Frax had that thought out, or they got that really right, and everything is like, I think of Curve's stable swap like technology as the ultimate mint redeem function that's ever been created by crypto. Like that people call it an AMM or whatever. I think of it as the greatest, most mathematically elegant mint to redeem smart contract that's ever been designed. So instead of, for example, us rolling our own PSM, for example, or like Frax having a mint redeem contract hand coded or something for any of our stablecoins, right? Like Frax, Frax Ether, FPI, we integrate with Curve, and that is our basically algorithmic mint redeem system, right? And we integrate in our balance sheet and everything like that. So when I look at innovation, I look at it in a stablecoin kind of maximalist centric view, which is look around. You see stability mechanisms and people working on like stability mechanism issuance. So like, for example, LSDs, they are ETH pegged stablecoin stability mechanisms. There's different ones, right? Like, for example, Rocket Pool has this kind of, two-sided lending borrowing thing where, people come and lend ETH, they get this ETH receipt token, right? Which they call an LSD, and then node operators borrow the ETH, right? And with some collateral of theirs as well, particularly ETH and some RPL or something. And then they run nodes, right? And then they pay the interest, which they call, POS APY, right? Proof of stake yield, but it's just interest, right? And so I try to abstract this out and look for innovation with that kind of lens in the world. And I say, which one of these, the things that people are building are the perfectly right, either super decentralized or, with real world assets, the right, legal structure or whatever to build stability mechanisms around for Frax, for stablecoins in general. That's why we call ourselves, like a stablecoin protocol and a stablecoin maximalist view, which is all of these things are going to converge on kind of this singularity of teams trying to get people to use their issued liability, whether they're dollar pegged, ETH pegged, BTC pegged, exotically pegged, as money, right? That's the final singularity, right? And basically how you get there and execute on that path is the most important thing. So kind of leave you with that thought.
Brilliant, Sam. Thanks so much. I'm loving all these answers. Yeah, I guess finally, yeah, Guy. So we've kind of talked about those innovations in DeFi that everyone's so excited about. Where do you see Ethena slotting into these other kind of DeFi apps, especially with their kind of native yield on the stablecoin?
Yeah, I think for us, we obviously just need to get up and running and show a bit of Lindy before we actually start talking about integrations in a more serious way. So I think for us, the way that we see USD fitting in as an asset within DeFi is basically just the uncorrelated point that I was making earlier, which is a lot of the yield-bearing assets within crypto obviously have that centralized component and obviously a censorship profile, which is obviously acceptable to some people, but we think should also be balanced out with trustless crypto collateral within our own ecosystem. And so I think part of what we think is interesting about this asset is to start putting in a yield-bearing asset, which is crypto native and censorship resistant, offers different qualities to different yield-bearing collateral within crypto. So whether that's sitting behind another stablecoin, whether it's an asset that can be levered in interesting ways in the same way that you can see Stani now coming onto Aave, and I'm sure Frax is going to be following a similar route. Your ability to be able to take an asset with yield that's generating an interesting unlevered return on the asset side, and then borrow stablecoins on the bottom to generate interesting post-leverage returns, I think is going to be a really interesting space to watch. And then I think on the perp side, there's a lot of blank surface area for innovation, I think, within perpetual dexes on chain, where there's just a bit more flexibility to take on yield-bearing collateral as margin instruments, or potentially stuff like staked ETH on a cross-margin portfolio margin basis. And I think some of the innovations that you're going to see there from Synthetix's V3 is going to be something to definitely watch in Q1 next year. So yeah, I think it's all over the place. It's really just the transition from stable collateral without a yield to stable collateral with a yield is going to unlock a ton in DeFi next year.
Yeah, fully agree. I think it's a great sign that we've talked there for about 20 or 30 minutes just on innovation in DeFi, particularly in a bear market like this. So yeah, thanks everyone. That's it for the formal questions now. But if anyone listening has any questions, we can open it up to a quick Q&A, maybe 2 or 3 questions from the audience. If you just request to speak, I can pull you up on stage and you can ask your question, or you can put it in the chat, whichever is easiest. But yeah, we can open it up now for maybe 5 minutes of questions.
Looks like so everyone's pretty shy, Connor. Might make sense just to wrap it up here.
I've got one question in here.
Yeah, okay, for it.
I believe from Brian. Brian, you should be able to speak now if you want to fire away. Hey, Brian, you should be able to speak now.
Yeah, great, thanks. Love the presentation. Love all the innovation within stablecoins. Obviously, it's showing the most adoption and innovation overall. The one that really stands out for me is this delta neutral strategy of producing yield. And I guess the question is more on the concern of controlling, like how some of these larger firms have been accused of controlling the price of gold, is that they're constantly shorting it, right? So when you create this collar around an asset, is there no more speculative value on it because you're constantly selling the highs and buying the lows? Is it just milking it for all it's worth? And if that's true, then if you could speculate on that going further. Thanks.
Yeah, I think it's a really interesting question on like the second order impact of what happens if you have a delta neutral stablecoin that's actually big enough to influence open interest across the market. So I think one thing to just point out is that the derivative market within crypto is actually still pretty small relative to total market cap. So ETH derivatives are at around 2.5% versus total market cap, and Bitcoin's just under 2%. And so just sort of the size comparison there, it's not enormous in a way that it can sort of like push down or keep control of swap prices in the way that you're describing there. The net effect, though, that you are describing would happen to a small degree. So you can think of someone coming in with whatever asset, BTC or ETH. If you're going to be hedging out that price exposure on a centralized exchange, for someone to step in and take the opposite position to you, i.e. take the long for the additional short interest that you're adding, if they're going to stay delta neutral to their own position, they might have to sell spot in order to take on that long futures leg. And so as you are sort of pointing out, there might be second order impacts where the price of these assets is sort of compressed and kept down through the derivative market. But I think this is like when we're talking about a delta neutral stablecoin, that's sort of like in the tens of billions rather than hundreds of millions.
Follow up to that is how would this be different than, say, an LP who's earning transaction fees? And I'll clarify that 80% of the times the markets are going sideways or they don't show a particular trend. 20% of the time they're trending, which can be that speculative side that you want to take advantage of. But markets that are chop city are actually great for LPs because they're earning massive fees. And I'm seeing innovation within the DEX space for liquidity providers, which is awesome. And you can earn just massive amounts being an LP provider. Can you make a distinction, or any of the folks here, of how we can have a flywheel effect of, hey, you can have a delta neutral strategy. You can also be an LP provider on your favorite assets. Let's say it's a try crypto. You like ETH, BTC, you like CRV, USD, or this delta. How can you be in a position where you don't particularly care which asset moves? You're happy to own any and all of them. I mean, if you have 10,000 plus ETH that you bought at $1, you're happy swapping it no matter what. But I think that these strategies could work well together. How are they different, and then how do they synergize each other?
Yeah, I can take a stab at that. I think obviously the delta neutral design is removing the delta of the underlying asset, so you aren't actually taking a view on whatever is the input asset coming in there, And so whether you have a view on Bitcoin or ETH or how they're going to trade together, it's kind of irrelevant within the delta neutral design because of the way that you're neutralizing that price exposure. The question around LPs and how that might interact with the hedging system that sits around it is a super interesting one, and I just admittedly need to spend more time thinking about your question. But I think that there is some non-linearity there, which also needs to be considered. So you like the exposure that you have within an LP pool is non-linear, just based on the way that it's sort of set up, and your ability to perfectly hedge that with perhaps is not possible in some cases because they're obviously delta one instruments. And so, yeah, I think that's one that I can sort of take away and just put a bit more thought into. But I think your ability to take out the delta perfectly within those LP pools is constrained by just the way that a perp is set up.
Perfect. Thanks, Brian. We've got one more question, I believe, and we'll wrap it up after that. Ferocian Torse, I'm bringing you up on stage. Just connecting. You should be able to speak now.
Sorry, am I audible? Just checking.
Yeah, we can hear you.
Perfect. So I had a question about RWA-backed stablecoins, and maybe Sam, you want to take a stab at this. I'm a little bit of a skeptical person by nature, and I think that systems that inherently can't be bad are better than systems that won't be bad. So does that make you a little bit nervous about adding RWA to the treasury of Frax and issuing stablecoins in a world where we have seen censorship resistance, and anything that can go wrong will go wrong? So how do you address that from a just like having this ecosystem be resilient long term?
Yeah, first of all, it's a great question. I agree with you on that. Systems that can become evil or go wrong will go wrong. So a few things. One is RWAs have a big spectrum of stuff, and as I think it was Kain or someone who said it during this call, like there's a wide spectrum of stuff, right? There's like car loans or motorcycle like lending in like far out lands or whatever. And then there is having treasuries or dollars deposited in a Federal Reserve master account if you have one, or if you're like a banking institution, which is literally the most risk-free thing you can do, minus, like you said, laws, legal regulations, and kind of those kinds of things, right? And so to be clear, when I say, at least for Frax, the dollar-pegged stablecoin, I say RWAs, I mean the far end of the spectrum. In fact, people know that one of the final goals that I've highlighted before is as regulation becomes clear, we want to be one of the few stablecoins to have a Fed master account. We want to be able to actually deposit fiat dollars at the Federal Reserve. This obviously requires a totally different regulatory environment. Clearly, it requires actual legislation in the United States. And so the first part of your question is, I just want to make it super clear, for dollar-pegged stablecoins, RWAs in our definition means the far end of the spectrum, close to risk-free in terms of economic risk-free when it comes to dollars. And so the second part of your question is regulatory and laws, right? Like you said, if there's things off of the blockchain, right, they have to interact with some kind of legal or state institutional like system. My view on this is that, and I don't know if you were here at the beginning of the talk or not, but my view is that in order to build a very, very large decentralized stablecoin at scale, so we're talking hundreds of billions, if not trillions, in the next 5 to 10 years, right? You cannot escape regulation and laws through decentralization if you're pegging to a nation state currency. If you're pegging to dollars, there's a way to actually solve the stablecoin trilemma. It's do not peg to a national unit of account. Peg to CPI or some stable standard of living. Peg to some kind of thing that is valuable, some new unit, and get people to adopt it, or peg to the most important fixed supply units of probably our lifetime or this century, right? ETH or BTC, right? These like extremely liquid, very, very decentralized, fixed supply-ish asset that are uncorrelated to consumer products or standard of living, right? Or like, the labor markets, basically, right? So with that, the main point that kind of I leave you with, which is like, you strip all of the economic risk first in the real world asset area that you want to work in, right? For Frax, the dollar peg stablecoin, it's pretty much risk-free dollars from dollar unit perspectives. Deposits of the Federal Reserve, the literal issuer of dollars, and short dated treasury bills, right? And then the second part is just how do you make sure that interacts the best possible way? There's obviously going to be some give or take, but the best possible structure for a off-chain asset like that, or like a master account, into a DAO or protocol or smart contracts on-chain, and right, and so Maker and Frax have slightly different but kind of converging ways of tackling that, and I think that's a very, very, very important part of the DeFi landscape, right? And there's some emerging kind of treasury bill projects or these kinds of things that also have a unique answer to it, but they're all in the abstract way trying to come up with a solution of saying, hey, we know how to interact with the state when it comes to that specific unit that everyone likes, needs, their debt is denominated. Maybe they don't like, right? Some people aren't very into the US dollar, but like everyone's debt is denominated in, everyone prices things in, everyone's like job or labor is sold in, right? Which is USD. And so that's how we think about it.
Thanks, Sam. That was a really succinct explanation. Thank you.
Well, yeah, that probably wraps up the spaces with that kind of great answer. But guys, yeah, just a quick note from myself, just to say thanks so much to everyone joining: Sam, Kain, Chris, Michael, Guy, and then we had obviously Rune and Stani earlier. It's been, yeah, massively kind of inspiring for me anyway, just to see everyone come together and just chat about like the future of DeFi and be pretty honest about what we're doing in the space at the moment. So yeah, just thanks from my end. Guy, I know you want to maybe say a quick word as well.
Yeah, no, just echoing those comments. I think it's pretty amazing to see everyone who kind of led the first cycle within DeFi here on the same call. They made huge contributions to the space in the last cycle, and they're still kind of here at the bottom of a bear market, grinding and trying to push the space forward as we go into the next cycle. So I think it's like a huge thanks from us. Massive respect for like still being here and grinding. And yeah, super excited to do it again whenever you guys want to.
Thanks, everyone. Take care.
Thanks, guys.
Bye. Thanks.
Thanks, guys. Bye-bye.
See you guys. Thank you.
This space was downloaded via spacesdown.com. Visit to download your spaces today.